Hey guys, Jacqueline Kreider, PBJ Mortgage, making mortgage simple as making a peanut butter and jelly sandwich. So let's talk about the difference between fixed rate loans and ARM loans. And ARM, by the way, is an acronym. ARM stands for Adjustable Rate Mortgage, right? Of course, a lot of people have a very negative connotation in association with ARM loans. And why? Because they think that's what created the big 2008 crash. That, oh my gosh, ARMs are the devil, and that's the whole reason that the economy just tanked and all the things. I get it. I understand. So first of all, let's talk about that. 2008 was partially caused by some of the loans, and some of the loans that did create some issues were ARM loans, okay? But there is a lot of bucket of ARM loans, and in a second I'm going to get into that. But are ARM loans bad loans? I will absolutely categorically argue that no. Actually, most of the general public would do better in an ARM loan than in a fixed rate loan. And in a minute, I'm going to explain to you why. So, fixed rate, what does that mean? Fixed rate means that your loan has a fixed interest rate for the entire duration of the loan. So if the loan is 30 years, that interest rate will remain the same. If that loan is 15 years, again, will remain the same. It will never change. The only way that the interest rate would change is if you refinance it, sell your house, buy a new one, basically create a brand new loan. But for that loan, the one that you signed up for, that you signed your life away, basically, right, to get, that one right there, that interest rate is not going to change. It will remain the same. Now, people say to me all the time, but I have a fixed rate. Why did my payment change? Most of the time, if somebody's payment change, that's going to be either their property tax or their homeowner's insurance. So if your property tax goes up, your payment's going to go up. If your homeowner's insurance goes up, it's going to go up, okay? So just understand, that's something that we don't have control over. The mortgage company does not tell your tax entity, so, you know, who is in your county, they don't tell them how much to charge you. I wish we could control that, guys, but we do not. So if those go up, we don't have control. Same thing with your homeowner's insurance. If your homeowner's insurance company says, hey, just FYI, we're going to raise the rate on this or that or whatever it is, yeah, I don't have any control over that. Sorry about that. That's just how it is. But the principal and interest part of your payment, which is derived by the amount of money that is owed and the interest rate that is charged over the length of time, that amount will never change on a fixed rate of mortgage, okay? Never changes. Now, let's talk about adjustable rate mortgages. First of all, most people refer to them as ARM loans. A-R-M. ARM, just like your arm, right? It is, like I said, that is an acronym for adjustable rate mortgage, okay? So there is two typical types of ARM loans that most people know. One is called a pure ARM, okay? A pure ARM means that each and every month the rate is going to do this. Okay, depending on what the market is bearing, depending on a bunch of different factors, that is how they're going to adjust that interest rate. Okay, so every single month, it's going to be adjusting. This is no different than a credit card. So remind yourself that your credit card can have an interest rate that adjusts every single month. So if your rate, like, it can move. Okay, now it may not move a whole lot, and that has to do with the index that it is tied to. Okay, but a pure ARM, every single month it makes an adjustment. If there is no adjustment to be made, it will stay the same, but it can make an adjustment every single month. The most common kind of ARM is something called a fixed period ARM. Fixed period ARM, what the heck does that mean? Okay, fixed period ARM means that for a period of time, the loan has a fixed rate of interest. Typically, it's going to be 3, 5, 7, or 10. Okay, so for these windows of time, there's going to be a fixed rate of interest, whatever that is calculated to be. Okay, after these windows of time, 3 years, 5 years, 7 years, 10 years, whatever that looks like, then the rate will start adjusting. And you're saying to yourself, okay, so what does that mean? How do rates adjust? What does that look like? The way that ARMs adjust is like this. So first of all, let's go back and talk about the pure ARM. Okay, pure ARM is usually going to be tied to an index. The most common index is going to be LIBOR or Treasury, MTA. Those are going to be your kind of most common. Occasionally, you'll find like a home equity line of credit, a HELOC. They can be tied to prime. Okay, sometimes they're tied like that. That's actually what your credit card interest rates, by the way, guys, are tied to, is prime. So like when the Fed moves the rate, that's what that interest rate is. Mortgages are typically not tied to that. Only home equity lines of credit are typically tied to prime. So there's that. Then you have something called a margin, okay? A margin, it could be zero, it could be negative, it could be positive. This is the figure that gets added to, that margin gets added to the index, whichever one it's being tied to, and that is what comes up with your interest rate. Typically, most of the time when an ARM, like an actual interest rate is calculated, they round off to the nearest eighth. Okay, there are some that don't do that. That's very odd. Usually mortgage interest rates are always going to be rounded off to the nearest eighth, either higher or lower. The same works for fixed period ARMs. They also have a margin and an index, and they get added together, and then the rates it's calculated that way. The difference on fixed period is the rate only adjusts according to the schedule. So like on most 3, 5, 7, or 10 ARMs, it's either 6 month or 1 year. So what that means is like, let's say you did a 5-1 ARM. 5 would mean the amount of time that the loan is fixed for. The 1 coming behind would tell you that each calendar year, so every 1 calendar year after the 5-year mark, there will be an adjustment period, okay? And then usually coming behind that, there's some other numbers. So for instance, a very common one is a 525. These are limits. Limits are what they can maximize on the rate up or down, okay? And you're saying like, okay, this is way too much math. Like what the heck does that mean? The easiest way to look at it is like this. Let's pretend that you start with, just to make the math very easy, a 5% interest rate, okay? You are on a 5, so for 5 years, you are fixed. Your rate cannot change, okay? At year 6, they're gonna go ahead and they're gonna see whatever the index that you're tied to is doing. Let's pretend for a second you're tied to the LIBOR, okay? And let's say that the LIBOR is at a 7%. When we go ahead and we look at the adjustment. So 7%. Then we're going to have, remember I told you a margin, there's something added. Let's say that your margin is 2%, right? So 7 plus 2 is 9. If 9% does not exceed 5% above 5, and what's 5 plus 5? It's 10, then the rate can adjust up to that level. Okay, let's say, for instance, though, that you had a limit of 226. Okay, that means 2%, the very first adjustment, 2% every year after that, with a 6% lifetime cap. The first example I gave was 525. So 5% first out of the gate, that first adjustment, right? In that particular case, using our same example, we were at 5%. The LIBOR is now at 7%. We're adding our 2% margin to it, and that equaled 9. But we're capped at 2% for that first adjustment out of the gate, right? So 5 plus 2 is 7, so that's the max it can go to. So even though it could have adjusted all the way up to 9, the cap will go ahead and keep that in check. The reason that some of the 08 problems arose is that a lot of the ways that the ARM loans were done, there wasn't a lot of caps and things like that in place. Now, I told you that most of the general public actually should take an ARM loan. Why did I say that? Do you know that the average consumer only keeps their home loan between 4 and 5 years? Between 4 and 5 years, one of the following things is going to happen. They're going to refinance. They're going to go ahead and maybe they're going to take some cash out of their house. They're going to buy a new house. Maybe they want to upgrade or downgrade, whichever way, right? They want to move. Their job moves them within that period of time. Typically, not always, but typically, the ARM loans are going to carry lower interest rates. So, why are you going to pay higher interest rate if you're not necessarily going to keep the loan over 30 years? They just scare people because of the fact that they can fluctuate. And I get it. They're not for everybody. I'm not making the recommendation that everybody out there gets an ARM loan. And guess what? Any really good loan officer will allow you to select whatever kind of loan product you want. The key here is education. We've highly recommended, we actually gained a client and he's done about 5 loans with us because we recognize on his credit report that he literally only kept a loan for 2 to 3 years max. And we ask him, hey, I don't understand. Why are you doing 30-year loans? You can be saving money by doing an ARM loan. Your history shows that you don't stay in a loan more than 3 years. So to help him out, we did a fixed period 5-1 ARM. So it gave him 5 years. It gave him an extra 2 years beyond what he typically is going to do. And guess what? Before the 5 years is up, if he chose that he wanted to stay there forever, he could go ahead and refinance and put himself on a fixed rate loan. Maybe he could pay it off. I mean, there's plenty of choices here. That's why when a lot of people say that ARMs are horrible, they're the devil, they're the worst choice ever, that's not necessarily true. Okay? You just have to understand that it's about the education. That's the key here. What does it matter? So that was a little bit of a dive into ARMs. I hope I didn't get too technical on you. I'll probably dive in and do more videos specifically about ARM loans and how they operate in maybe some later videos. But this should hopefully give you a little bit of an understanding of like what an ARM loan and a fixed rate loan is and what the differences are. It's just important to note that all the mortgage products that exist are there for a reason. There is a client that they are perfect for. The problem is that not everybody fits in that box, right? You're a unique person. You have unique goals. You have unique things that are going on in your life. And guess what? I, as a professional, it's my job to ensure that you get in your perfect program. Okay? And that's why I have to ask questions. I have to look at your history. And I even have to see things that you can't see, right? That's my job. And so what happened before '08 is a lot of people just stuck people in loans they really shouldn't be in. Now, the law tells me that if you qualify for a loan and you want it, regardless if I think it is a horrible idea or an amazing idea, I must put you in that loan. So just so you know. However, any good professional is going to have a conversation with you, tell you why they believe that this is the best product for you, and that's why it's so important you pick somebody that you can trust, that you feel like really gave you good information, right? So there's a difference between fixed and ARMs. Hopefully that helped and didn't confuse the heck out of you. I'll be back with more information soon.